Hi everyone, and welcome to another episode of Quick Take. This time we are looking at BHP Billiton. For those who do not know, it is a mining company. Well, they call it a global resources company. So producer of commodities, iron ore, metallurgical coal, copper, uranium, and all of that. So basically a really big Australian mining company, and we'll be looking at it today and see. So it's considered one of the blue chip stock on the ASX. It's a huge company. Its rival is Wesfarmers, and I did a video on Wesfarmers the other day. Anyways, let's have a look at the ratios. Give it a few seconds. P ratio 21. Not bad for a really big company. It's a multi-billion dollars multinational company too, so that's good looking. All right, let's move down to, let's see, quick ratio 1.17. So again, that's impressive considering how big it is. So it has enough cash to last for 1 year, or a little bit more of a 1 year. And its dividend yield is 3.59%. That's pretty good. Now, one other thing about mining company, and I guess we'll talk a little bit more about it when we look at the chart, is that they're usually a cyclical company. So there's basically it moves in cycles. So there's going to be year where there's a lot of demand for its offtakes and products, and there's years that it was really quiet, and it goes in cycles. So in some way it goes, you can match it up with maybe market, like how fast the market growth rate. Yeah, so if a market kind of plateaus, so let's say BHP Billiton sells to China, and China is booming, with iron ore needs iron for construction, and then suddenly, just if China plateaus, because if it puts a lot of chips into one basket, then then its sales gonna slow down, then its earning gonna slow down, then its shares gonna fall and stuff like that. So these like mining shares tend to be more cyclical. All right, BHP, let's see the annual cash flow statement. 50, so it drops. You can see this makes sense. Yeah. So when you're looking at these, you want to try to rationalize what's happening. This makes sense, and in the short term, it's going to affect the share price. But again, I think it's just a huge company, and growth rate around the world is gonna, like restart again. So 2020 pandemic happens, China slows down, supply chain slows down, and stuff like that. So it can't sell a lot of its products as it would have liked, and growth rate around the world actually slow down. But China reported increase in GDP. I think it's 2 to 4%. I can't remember what the figure is, but China is definitely doing better than the rest of the world. So obviously, things like this you got to rationalize. Like, hey, why is it dropping? Is it because of poor management, or is it because nobody wants its products anymore, or because people don't need the product at the moment because of certain other external factor? And in this particular situation, the pandemic has slowed down the global economy. Investing activities, again, that's fine. So negative financing activity. Let's see, paying back debt. Again, that's fantastic for a really huge company, especially mining company. There's a lot of overheads. You got to consider labor, machineries, plants, mining, all of mines. So paying back debt, that's $1.5 billion worth of debt being paid. Paid $6.8 billion worth of dividends. Again, we want to look at how stable those dividends are, and also the franking credit. So maybe we will have we let that load while we continue on. Let's see right here. All right, moving on to the balance sheet. Current asset dropped a little bit. So let's have a look at inventory. Inventory increased. Now with company retailers and And companies that has goods, that sells goods, you want to see inventory, the turnaround of the inventory is quite high. If there is an increase in inventory, you want to see if there's an increase in sales rate also. Typically, preferably, you want to see sales, the growth of sales exceed the growth of inventory. But if there's a growth of inventory, if the growth of inventory is higher than the growth of sales, then you kind of like, hey, what's not selling? Why? You want to get rid of the stock that's not sells really quickly and reduce that inventory. And this is one thing when you're looking at assets, current assets. You want these breakdowns. You want to see, is it what are the compositions of the current assets? Is it a lot of cash from receivables or cash on hand, or is it mostly inventory? If it's a lot of inventory, you want to find out why. If it's just warehousing inventory, it's not a great sign. Like basically, it could mean, and it's most likely to mean, that the companies can't get rid of stock. Maybe it's contracted to with its manufacturer. So I'm not talking about BHP in general, in specific. I'm talking about just companies that hold inventories. If it contracted to produce with the manufacturer to produce a certain amount, and if sales slow down and it's still being produced, got to pay for those goods, and it has stock somewhere, and then it's stock in the warehouse, the inventory goes up. And if you don't check the breakdowns of the current asset and say, hey, and see that inventory is actually the stockpiling, then that's a bad sign. If it's stockpiling, you want to see inventory move out, cash sales goes up. If both of them goes up, you want the sales to be the growth rate of the sales to be higher than the growth rate of the inventory, because this means it's getting rid of more than it's making, which is showing there's a demand for its product. All right, liabilities. So let's have a look at the cash. Cash is 3 billion. Current liabilities. Total cash investment is 13,429, while the current liability is 14. So not sure how that comes to 1.17. So that's one thing about. That's one other thing about. What is it? Investing.com is just the figures sometimes don't match up, or it's just missing figures, so you can't actually do calculation. But let's just quickly figure out what's happening here. 13129. I assume it adds the total receivables here also. Let's see if we can come up with that figure divided by 14.8. So 159 divided by 14,824. Yeah, okay. So that's probably what happened. They add these two figures together, 13,429 plus 3,730 divided by the total liabilities. Something like that. So you want to understand these ratios and some of these figures. All right. So how's it looking? It's looking fine. It's looking fine. If you buy it, it's definitely a safe investment. Being such a big company, and especially mining company, you want to buy it at the right time, because if you don't, you might buy at the high, and then you're gonna wait many years before it comes back to the same high again. So you want to buy at the low for these companies. Like, well, how low? How do you determine the bottom? Well, you can only really see a bottom in hindsight, like the true bottom in hindsight. So you want to be able to look at the chart and say, right, there's some momentum going up, the market's looking good for this particular company. Like, let's say we found a really effective vaccine against COVID-19, and productions, construction's picking up, and people need iron ore and all of that energy resources to expand cities and build cities and stuff like that. And you say, hey, then there is a demand for all those resources. And if these companies sitting on like ores of like resources, then that's they potentially have a lot of assets, and those assets will generate money if the demand keeps up. So you want to look at the macroeconomic factors also when you're looking at some of these companies, because they are affected by it's those factors. All right, total revenue, again, it's not surprising that it's lower in 2020, so that's fine. Let's go straight to net income. See, it's not because it's there's many factors, and I think the pandemic plays a big role in bringing that number down. So I'm not particularly too worried about this lower net income for this particular company. All right, let's quickly look at the franking, 100% franking. That's really good. So at the moment, the ASX is estimating as 4%. Again, that's also a really good deal. So let's have a look at the chart on trading view instead of there. Okay, so there you go. You can see that there is some sort of, let me maybe even come out into the 1 week and let's have a look at it. All right, where are we looking? Wow, what a bargain, eh? It's $2 in 2000 gone up. So it's not as is it clear a cycle like you expect to see in a sine wave like this, but it's definitely there's cycles to it. You can see that this one here is just a 2008-2009 crash, but it recovered, then it comes down, and then it's coming back up, and then there's the COVID-19 crash. Now it's hitting coming up to this resistance level, and then it's coming back down. So yeah, look, it's let me just zoom out. Okay, so yeah, look, the income, we already talked about that. So what we can see there is that it could be hitting that resistance. So I'm going to draw the resistance line right here. There we go. So it's just sitting nicely there. People are saying, hey, so day traders saying, let's say some day traders are trading this particular company. They probably hold off on their buying, or maybe they started a short position, or so it reduces demand for the stock, and then or maybe they're cashing out because they're like, hey, this is the top, I'm going to cash out before it goes down, and then I'll buy it back again when it hits a certain low. So there's definitely less demand for the stock. You can also see the traded volume is much lower than before. So it's just a sign that it's on its way down. It's just doing its cyclical thing. Look at with the current trajectory of the whole economy, I think it will go down unless the vaccine comes out. Then I think the all stock will shoot up. A really effective vaccine comes out, or maybe just, hey, bam, one day suddenly COVID-19 is gone, like let's say tomorrow, then the market will be really, really happy. So yeah, I just don't see it. It's definitely not a buy time. It's definitely a solid company, and I would invest in it if I have money lying around, but definitely won't be investing in it now. I think it will retrace back to its level somewhere down here, or maybe just a little bit higher, so around this point here. So I'm just going to draw that one there. And maybe we chuck in the Fibonacci sequence. So it's being, you can see from the RSI that it's being overbought. Maybe you can chuck in a financial, not financial indicator. I wonder if I can MACD. I'm just gonna get rid of this and indicators, and let's go RSI. There we go. Oh, nice. I can fit both. So yeah, it looks like it's gonna cross here, so it's hard to tell. And I also have the ATR, the chandelier stop here. It hasn't to sell yet. When it turns purple, that's mean it's kind of like a sell signal also. So at the moment, it's not a sell signal, but I believe that it will soon. So I'll probably review this particular company in 2 weeks. It's one of those really slow moving company. And that's totally fine. Sometimes you want some of these companies in your portfolio just to kind of like have that stable kind of growth, but you want to review it periodically, so then you can sell it to make a profit and then buy it again once it's get down to its lows. And that's one of the great things about some of these stocks. It's predictable and you can make money out of it, but it's just very, very slow. And if you're one of those traders, investor who likes a little bit of excitement, I think you won't be looking at this like, too frequently. Let's chuck in a fib and call it a day. Let's get a Fibonacci retracement. Draw the... Always do this wrong. Next time... All right. I'm going to expand this so we have a lot of real estate. Okie dokie. So you can see there the dip down to this 26.45, but really if you're looking at so it is 26, maybe no. So let's say you check this stock at this point and then you say, well, it's going to retrace. And you can say that the retrace to 40.78, which it did, and then then say maybe it's already given itself some breathing room. We'll go up, so we'll go up to this and test this resistance and come back down. But this is because of the pandemic. It dropped nicely to 38.2. So that's a retracement. You can see there, retracement there, and then it went back up, and now we're just looking forward in time, or predicting forward in time where we'll go. Look, it can probably hit, so it can do this double top thing, but I think if it does, then there might be it's giving itself a room to maybe continue upwards, maybe towards the $70 mark. That could also be a possibility, but I think again there's a higher chance of it hitting this. If it does hit this and come back up, it will retest and come back down because it has never been higher. And, there's no catalyst to say it will go higher unless suddenly, let's say, a lot of other country decided to spend a lot more money in development and infrastructure. So it probably will hit so there's a support here. So right here at the 78.6 mark, the support, if it hits that and continue down, then it most likely will continue to go down to this part. Again, it would break through, then it will continue. I would say, this one is probably a strong. It's already it seems like this one is of quite a strong support here at the 78.6 mark. But if it breaks through, it's definitely coming down to, I say, right in the 0.5. There's really nothing here to stop that to go down toward this. So you can see, let me draw that. So, what's happening? So it got a support here, right here. So that point. So it will, if it breaks through, it goes straight down to 0. If it breaks through to 78.6, it's going to go straight down to the 0.5 mark, or 0.78. It's easier to say 78% rather than 78.6. So 78% going straight down to the 50% retracement. So, and then it's again you kind of predicting the future, and nobody can really do that. But if it does go down here, I might consider, but I just don't think that will be. I would buy this anytime soon. I'll probably buy it when it gets down to this particular point, or even down here, 13. But I think I will be happy at 19. But even though, let's see. So if it moves down from, let's say, this point, so 19 mark going down to 13.70. So 19 take 13 equals 3. 6, right? 6. So 6 divided by 19. So that's a 31% decrease in my stock value. So I got to really be careful if I want to buy it there. But yeah, I'm not buying it anytime soon. But if it does get down there again, this is one of those dividend paying stock, and the dividend will prevent it falling any further, because it's probably, if it gets to, let me see, actually let's do some more calculation, and we ended dividend amount, so 0.75 cents per share. So if, let's say, it keeps that 0.75 at the moment, it's what's the price at the moment? 44.12. So divided by 44.12 times 100, 1.62. What is that? Annual yield. Oh, we can just use that and work backwards maybe. So 4%, 44, 12 times 0.4, 1.76. Well, that's not what it's saying. So you want to find out what's the what is it, the pay per shares is. I estimated from this and the share price, it's supposed to be 1.76, but you can look at that in the annual report. I can't go into this in the quick take, otherwise this video would be too long. But yeah, anyways, short story is solid company, but not time to buy, since it's cyclical, and it's hitting its technical highs and resistance. Yes, so if you like what you see, if you like what you watch, please leave a comment, share, and subscribe. If you have any comments regarding this particular company, leave it down below. Again, be civil. If you want me to do it, a quick take on any other company, again, leave that in comment and I'll get back to you with that. Beside that, that's pretty much it for today's quick take. I hope you guys have a great day and great time trading ahead. Again, don't invest or trade what you can't afford to lose. Take care.